Hey everyone, this is Stock Investing and Trading 101. Today the topic is going to be how to hedge your portfolio. Before we get into that, you need to know what the definition of hedging is. Essentially what a hedge is protection. It's pretty much an insurance policy. So when you're hedging your portfolio, you're pretty much having an insurance policy in case the market decides to crash or correct. That way you're not going to lose tons of money if something did happen. So when you're hedging your portfolio, it's just pretty much insurance or downside protection. There's many ways that you can hedge your portfolio. Some of the classic ways are hedging it with gold. You could diversify. You should always be diversifying in bonds and asset classes, precious metals. There also is other funds and other ways to hedge. The first one I'll get into is just putting puts. So you can do what is called protective puts, which is essentially to hedge your portfolio. Let's say you are heavily invested in the S&P 500 or many S&P 500 companies. What you could do was get an option contract called a put. Purchase a put that has a far out strike price, so maybe like 3 to 6 months away. I'd recommend as far out as possible. And essentially, what this put is going to do is, as long as the market goes up, the put is going to lose value. But as soon as the market makes a big move downward, the put is going to gain in value. And the best place to do this would be at a market peak for all of these positions. So you're never really supposed to try to guess a peak, but obviously when it's near all-time highs, you can kind of imagine that it's not going to go up too much further. So if you were to hedge above maybe 300, you could do that with a SPY put. So if the SPY was at 300, you could go buy a put with like a 300 or a 295 strike price. And if you would have purchased that somewhere, up around here early this week or even last week, this 10-point move here would have became worth tons and tons of money. The only downside is to buy a put that far out is going to cost quite a bit of money, at least probably 2 to 3 thousand, maybe possibly more, because it's just got so much theta in it and so much time that you're paying a good amount of money for that. Some other hedges are VIX. What the VIX is an index that measures volatility, and VIX has many. You can't directly trade the VIX. It's just a index, and you can't directly trade it, but that does have many ETNs and which is an exchange traded note, and other types of instruments that can be used to trade the VIX. The thing with the VIX is, while it does typically go inverse to the market, it doesn't always do that. So don't just assume that because the market is going down that the VIX is going to spike, because if it's going down, just slowly and surely, and there's no huge volatility, the VIX won't necessarily spike. It's got to be kind of a random and volatile move for the VIX to spike. Also, on top of that, a lot of the instruments used to trade the VIX, like TVIX and VXX, and many instruments are leveraged. So, especially with TVIX, I talk about TVIX a lot. TVIX is mainly used as a trading instrument for day trading only. TVIX should rarely be held for multiple days, if any days at all, because of what's called contango. So these leveraged VIX funds are made and designed to go down. If you look at one of these VIX ETNs or any of the most of the funds that follow the VIX, if you look at a long-term chart, it's just going straight down. So if you look, if you were holding the TVIX from 10 years ago, it would pretty much be worthless by now because of contango, which is essentially just the price is designed to go down. And while there will be spikes to cause it to go up, in the long run, the contango and the downtrend and the all of that are going to kill you. So TVIX isn't meant to be held for long periods, which is why it's typically unsuitable as a hedge, because you want to hold a hedge and, be able to hold it without its losing all its value. And if you're holding a depreciating asset, it can screw you over more than it can help you sometimes. Some other hedges are, you might have heard of the SQQQ. This is a short for the NASDAQ fund, and this will somewhat work as well, but I believe this is also leveraged. I try to stay away from leveraged funds unless it's for a day trade, because I just want to be safe than sorry. And one of the last hedges that I would get into, and I think this is more of the common man's, regular hedge, is a fund called SH. And so this isn't leveraged, and essentially this fund is made to mimic the inverse of the S&P 500's daily move. So this is a true short fund. It's not leveraged, and it's not necessarily designed to lose its value over time. So if you compare 1 year chart for these two funds, you'll see that they're pretty much inverse of each other. You have this huge bottom here around December, where this fund is spiking around that time in December, and here we're at pretty much all-time lows while the market makes new all-time highs, and then we have this huge spike up while the market is making this huge move down. And essentially that's how a hedge will work. So if you were to hedge your portfolio at, one of these peaks or high points, it would be one of these entry points, meaning, there's some money to be made, especially if you were able to, pick the peak very well, and if you were able to purchase either here or here, you would have had a few dollar move, and this is only a, $27 stock. So, there's many ways that you can hedge your portfolio. I think, in my opinion, the best ways would either be something like this, which is kind of like a plain, just a boring hedge, which, isn't bad. Most of the time, boring with stocks is actually good. Or they do have options on the VIX, which again is a volatility index. So you can trade calls and puts on the VIX. And VIX calls with long-term strike prices are typically better than TVIX. And that's because these VIX calls aren't there's no contango to them. TVIX, once again, was built to go down with time, and it's going to go to zero until it reverse splits, until it does it again, and repeats the process. With VIX, it's different. It doesn't have contango. So with a VIX call, if you got a VIX call 6 months out, it would be a suitable hedge in some situations. So this is just something that I wanted to bring up and to let tons of people maybe get the idea of. When I first started investing, I didn't know exactly what a hedge even was or how I could implement it. And from trial and error, from using some of these different instruments, I figured out what was going to work for me and what wasn't. So I just wanted to remind everyone that this isn't financial advice, this is just for entertainment. This is just my own personal thoughts, not suggestions. So always do your own research before making any purchase or sale in the stock market, of course. But definitely look into different kind of hedges, and maybe, do some research or do some experimentation with what hedge is the best for you and what could be suitable. Because if the market were to make a huge correction or go into a bear market, it would be a really good idea to hedge your portfolio, because if we tested this low again right here, that's down to 273. That's a big move. So all that profit in the market that you made, you could lose. And essentially what a hedge is going to do is allow you to lock in that profit without selling your stock position. Because I know many investors are, forever investors or long-term buy and hold. That way you don't ever have to sell your shares and you can still remain protected. So I hope you guys liked the video. If you are hedging your portfolio already, I'd definitely be interested in hearing what you're using as a hedge. For me, typically it's VIX calls or sometimes the leverage funds if I want to gamble a little bit and I have a good inclination that the market, something big is coming. But other than that, I like to keep everything safe in my portfolio and, nice and easy and not too crazy. So that's why I like to stick with stuff that's not too leveraged. But either way, I hope you guys learned something today. I hope you guys liked the video. Please check out my other videos, subscribe to my channel, and we'll see you guys soon.